Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Wait for it, broke out of the range. We've seen this 280 to 290 range. We've been talking about it for weeks, over weeks. Finally saw a trade north of 290. A little bit of a surprise, I think, that we got yields to boost higher. But from a technical perspective, we're now targeting 310. Yes, I know 3% is going to bring out all the fanfare and bells and whistles, but I think on a technical perspective, 310 is our next upside target. Likewise, if we get back below 290, it doesn't mean we're going to be back in that old range, but if we do get back down 280, 290 range and start to build a home again, maybe this is just an anomaly trade on a, sort of a one-day oops moment, but that is yet to be seen. So right now, yields back above 290, possibly on their way north of 3%. If you look at market volatility, we broke out of the range, we broke out of expectations. Yeah, we got a little bit of modest bid in volatility, but nothing that I would say considered is sort of a fear trade, more of a reactionary trade. So volatility a little bit higher. I think we need to see yields continue to go higher in the back end of the curve before we see any significant shift in Treasury volatility, and that takes us to the curve. Right now, we're watching the curve get flatter and flatter, and all those fears of inversion, which would then be followed by recession. Well, over the last two sessions, we've seen quite a significant bounce in the 2s, 10s, or 5s, 30s, or whatever yield curve you're looking at. So we have seen a modest steepening of the curve. If you go back and look at a 5 or 10 year chart, it really doesn't look like much, but on a 1 or 2 month chart, it looks pretty significant. So, and every marathon begins with one step. So right now we are seeing a modest steepening of the curve, with the short end outperforming for the first time in a long time on Treasury speak, and that could be something that is welcome not only by investors but also by the Fed. The Fed looks at that inverted yield curve and probably starts scratching their head, because if you can get 4% growth at 2% inflation, but you've got signs of a recession coming, that isn't helping anybody, and certainly not the Fed, who wants to continue to raise rates gradually. So right now, the Treasury curve helping the Fed as yields inch higher, break out of the range, but we do have a lot of data, earnings, and GDP on Friday, so a lot can change very quickly. This is Todd Colvin coming to you from the floor of the CME Group.